Thank you so much to the organizers for having me be part of this absolutely wonderful conference and also this super interesting session. So this is joint work with Tatiana Baliuk, who's at Emory University. So it's widely believed that financial technology has revolutionized person-to-person payments. And this is even true in the United States through applications such as Cash App, PayPal, Venmo, and Zelle. And these are person-to-person payment systems where funds are transferred directly person to person. Now, you can see here that there's been an exponential increasing demand for use of these systems. So this is data from insiderintelligence.com, and it shows that by 2024, it's expected that there's going to be $170 billion of US peer-to-peer mobile payments in the United States. And to put this into context, there are going to be around 70% of US smartphone users that have sent at least one person-to-person payment via one of these apps. Now, why is this demand so exponential? Well, because previously sending funds to friends and family was significantly less efficient. And these inefficiencies really manifested in the time to receive or uncertainty around when the income would become available to the recipient of these funds. So let's, for example, take traditional methods like ACH, check, cash, or wire. So with ACH, when would the funds become available to the recipient? Well, it could be immediate to several business days, and this can be further complicated because of situations like banks not being open or operational on holidays and or weekends. And so the fact that they're not open means that transactions are not cleared and those funds will not be available. Check, well, you might have to send the check in the mail. And then if you receive the check or you have to hand it physically to the person, there's significant uncertainty as to when the funds will be available, because they can be available next or second business day, but then there's variation in the cutoff for business days, and that's going to vary by bank. Cash, we have to physically get the money to somebody. And wire, well, this is different, but it can be immediate. The funds can be received immediately, but there's a very high flat fee, and this is often true for both sender and the receiver. And also there's some operational challenges in actually setting up a wire transfer. I'm not sure if any of you have ever done that. It's not super easy. Now, this uncertainty around the timing of receipt of income is thought to be particularly problematic for people who are living paycheck to paycheck. And in the United States, there are many households that live paycheck to paycheck. And this is because these households, by definition, have very little liquid savings, because most of the income that's coming into their account goes right back out on key and crucial expenses. And so this topic of real-time payments is actually a current policy discussion where it is believed that the delays or uncertainty around the timing of receipt of income can be problematic for these people who live paycheck to paycheck, because they might then incur negative knock-on consequences such as overdraft fees, late fees, NSF fees, things like that. So we think that this is true, yet we don't really have any concrete evidence in the United States that this is true. So in this paper, we are studying how access to the peer-to-peer payment systems apps that I showed you on that first slide, how access to these apps, which are, the apps allow for low cost and instantaneous transfer of funds person to person, how this impacts consumer outcomes during periods of liquidity stress. We do this via a number of steps. So first of all, we have to pinpoint moments of liquidity stress, which is non-trivial. And then we have to document during these periods, then we document that people receive more of these inter-household transfers. And we also document that people receive more of these inter-household transfers in a small window immediately prior to key fixed expenditures, such as housing, bills, credit cards, or car payments. And then we also find that access to these peer-to-peer payment systems apps is associated with an increased ability to match these transfers to these key outgoing expenditures, and also a reduced likelihood of incurring these low balance fees like overdraft and NSF fees down the line. So how do we do this? Well, we have access to massive amounts of data on individual income and expenditures from bank accounts and credit cards. So we obtain data from a data aggregator who provides de-identified data to us on around 60 million people in the United States. Our data ranges from 2010 to 2021 in this case. and we can see all sorts of things at the transaction level for each individual. And so let me give you an example. This is just for illustrative purposes. We make use of the categorization provided to us by the data provider, but we also then make use a lot of what's in the transactions description. So you can see personal identifiable information is X'd out, but yet there's still a huge amount of information that we can gather, especially things like Zelle, Venmo, Cash App, Wire, PayPal. And this allows us to really categorize and identify these person-to-person transfers via these specific systems. Okay, so first step, how do we pinpoint periods of liquidity stress? The first way that we do this is we use a representative sample of the US, where we sample people along income and geography dimensions so that they look like the US population as a whole. And we look for what we're calling endogenous income shocks, where we look for a moment in time when a person's income has dropped below the median of their lifetime income, and it has stayed below the median the following month, and it was not below the median in the previous month. And so in this way, we're able to study the broad population, but again, our income shocks are endogenous. We also focus on a second, more specific time period and a more specific set of people. We make use of the government shutdown of 2018-2019, where hundreds of thousands of federal employees did not receive income in the first weeks of January 2019. We're able to identify these people in our data. And so we use this as another income shock, relatively exogenous, but transitory at a specific point in time, focusing on a specific group of people. So just to show you sort of what this income shock looks like now for our government shutdown sample. So this here is the difference between federal employees who lost their income in the first weeks of January versus federal employees who did not lose their income. And you can see here that the income shock was large. In total, these people lost around $3,600 of income. And it was partly recovered when the government reopened in early February. That's because some people worked without pay, so they got back pay, but lots of people did not work. So it was a significant but transitory income shock. Now, one of the first contributions of our paper is to document systematically how people cope during times of liquidity stress financially. So we see here that there's a dramatic increased likelihood of receiving a friends and family transfer. People who lose income, they also draw down on their liquid savings, and they also cut spending. And we find that this is true across both data sets. So that was for the government shutdown, which is our nice exogenous but transitory income shock. We also find these patterns hold for our more representative sample of people. So we find that people, importantly, they receive more of these inter-household transfers. And then we also find that they match these transfers to outgoing expenses more. So just to be clear about what I mean by that, so what is transfer expense matching? Well, given the granularity of our data, we are able to observe exactly when the transfer occurs in relation to one of these key expenditures. And so we take one of these key expenditures, and then we look in a 3-day window prior, and we say then that that transfer is matched to the expense if it occurs in this short window prior to the expense. And we find that these inter-household family and friends transfers tend to occur in these 3-day windows, but we find that this happens more so during periods of liquidity stress. And this could be for a number of reasons, such as maybe if the funds are earmarked for a specific purpose, then you're more likely to get those funds, or maybe it's a reduction in moral hazard. Maybe you're more likely to get them if they come close to the expense date, so you're less likely to waste them. That's definitely an area for future research. Okay, so taking stock of where we are so far. So we have pinpointed these periods of liquidity stress. And in these moments, we show that people receive transfers from friends and family. We also provide new evidence that when people receive transfers from friends and family, they're often matched to outgoing key sort of consumption commitments. And this happens more so during periods of liquidity stress. And hence, we argue that we are identifying the exact moments when the timing of receipt of income especially matters. So now what we're going to do is we're going to zoom in on those exact moments, and we're going to assess to what extent does access to these peer-to-peer payment systems apps impact, first of all, the likelihood of matching and also other consumer outcomes. Okay, so if we just did a simple, assessment of correlation of how P2P payment app use is correlated with consumer outcomes during periods of liquidity stress, this would be problematic. Why? Well, the use of the peer-to-peer payment systems apps is probably correlated with these nebulous, unobservable user characteristics that drive both outcomes as well as use of the peer-to-peer payment system apps. And hence we need an instrument, which is just going to be variation in access to the person-to-person payment system apps that is unrelated to these nebulous individual characteristics. Sounds straightforward, but of course, instruments are always hard to find, right? So, okay, so let me tell you about the instrument that we're proposing. We're making use of 3 features of person-to-person payment apps. First of all, P2P payment apps are network goods. So my own use is going to be a function of the use of others. Secondly, the use of one person-to-person payment app can have spillovers into the use of others. So for example, if I use Zelle and I have a good experience with Zelle, then I might be more inclined to use things like Venmo, PayPal, and Cash App. And finally, and importantly, the likelihood of using Zelle specifically is a function of whether or not your bank offers it. This is because Zelle is specifically offered through banks. Okay, so now how do we make use of this? Let's take 2 hypothetical people. Let's say Mary and Brenda, and they live in Atlanta, Georgia. And at a hyperlocal level, in Atlanta, Georgia, these banks have Zelle Bank. There are Zelle Bank partnerships. At a hyperlocal level, both Brenda and Mary are going to have the same sort of access to person-to-person payment apps through these network effects and these spillover effects, given the local exposure to Zelle. Now, let's suppose that Mary has a close social circle located in Chicago, and Brenda has a close social circle located in Boston. How do we locate where their close social circle is? Well, we observe the location of transactions around major holidays such as Thanksgiving, Christmas, and the 4th of July. And we look for repeated transactions in these locations. And we argue then that this gives us a nice window into the location of their close social circle. We actually validate this measure of distance with Facebook data made available from Opportunity Insights, and we do pretty well with that correlation. Okay, so now Brenda's close social circle has exposure to Zelle in Boston, but Mary's does not in Chicago, and hence we argue all else equal that Brenda has more access to person-to-person payment apps because her close social circle has more access to apps in Boston. And we find controlling for city of residence fixed effects, and that there is no correlation between consumer characteristics and exposure at the location of close social circle. And we can't obviously test the exclusion restriction directly, but this gives us confidence that we're doing okay. So we also find in a strong first stage that Zelle exposure of bank partnerships at the location of close social circle strongly predicts both Zelle use and other person-to-person app use. And so we argue that we have a good instrument for this, for the P2P app access. Okay, so now I'm going to tell you what we find in words, given this is only a 15-minute presentation. So how do we find that access to these apps, how does this impact people during periods of liquidity stress? So again, we focus in on these specific moments where people are particularly liquidity stressed, and we find that access to P2P payment app systems results in an increased likelihood of matching the transfer to the outgoing expenditures. And we also find that people who have more access are less likely to incur overdraft and NSF fees down the line. How exactly does this happen? So we argue again that when people receive transfers during periods of liquidity stress, they want to do it in that 3-day window prior to an expense for various theoretical reasons. And when people do not have access to technology, there's much more likelihood that that transfer is going to happen outside of that 3-day window after the expense, and you're going to incur an overdraft fee. And so we argue that our findings are consistent with access to this real-time payments technology increases the certainty of timing of receipt of these transfers. So these transfers are more likely to occur before that expense happens, and people are less likely to incur overdrafts. Okay, so to wrap up, we show in our paper that consumers often rely on these inter-household transfers in times of need, and that peer-to-peer payment system app access improves these the ability for households to make use of these inter-household transfers and improves the matching of the timing of transfers to expenditures. And then we see that that improves, it reduces the likelihood of these low liquidity penalty fees. And so we argue that this is really the first concrete evidence that access to real-time payments for people with low liquidity in the United States can have really meaningful impacts. And we think that this contributes to the policy debate right now. Thank you.